Good morning and welcome to this Wednesday, March 23rd, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it was 2 years ago today that we hit our pandemic bottom. It was March 23rd, 2020. That was the day the S&P 500 fell back to 2191. At the low, I think we closed at 2237 that day. And now here we are fretting over 4,500, which is about where the S&P closed yesterday, closed at 4511. It's all about perspective. The market at the beginning of the year, 4,800, dropped back to 4,100 and change, now back up over 4,500. And yet, we only kind of think about the moment and not where we were, not necessarily where we're going. It's right now. Are we at a buy point? Is this a sell point? But when you try to keep things in perspective, we're in a secular bull market. And so, whether we go up, whether we go down from here, it's really hard to predict the market. It does give us some signals, but have we bottomed with all the selling we saw? It's a great question. I'm not convinced that we have, although obviously with every point that you move higher, you get further and further and further away from those lows, and you begin to think that's probably it. But I would still say it's probably 50-50. I think there's still a shot that we go back down one more time. It's kind of hard to imagine with everything going on. And honestly, sentiment very quickly in the options world, very, very quickly back to the bullish side of things. That makes me a little nervous. So there are some signals, and we're going to talk about a bunch of those signals later today. I do want to make sure everyone's aware that we have a market update later this afternoon. It's free, so anyone can attend. It's the 2022 Q1 market update. It'll begin at 4:30 p.m. Eastern Standard Time. If you go over to our website at Earnings Beats, you will see we have a little blurb about it on our homepage. So go to earningsbeats.com. and you will see this. If you're interested and you'd like to attend, and you're not already an Earnings Beats Digest subscriber, you'll want to go in and fill this out. Just name an email address. That's it. No credit card required. You can unsubscribe at any time, but fill that out, hit that subscribe button. In addition to receiving room instructions later today for the event, you also get a newsletter 3 times a week. So I think it's a great newsletter. It's a way we give back. It's educational in nature. You can use that information to trade if you'd like, but of course that decision is completely up to you. As I like to mention, often we are not registered investment advisors. So I'm not licensed to provide recommendations and advice. What we do is provide education, guidance, basically opinions, and you can do with that, what you'd like. But we do have that event coming up later today. So I just want to make sure everyone is aware of that. 4:30 Eastern later today, Q1 market update. I'm going to go through a lot of ratios. I'm going to take a look at the dollar, look at some commodities, look at really everything, and just see what the technicals are telling us, what some of the underlying signals are telling us about this market, what we might expect as we go forward. I can promise you one thing, you probably should be expecting some volatility. And that's what we talked about at the beginning of the year. And certainly we've seen that. I don't think it's over. I think we are going to continue to see a lot of volatility, but make sure you tune in later today for that. Love to have you. Futures today are down this morning, but we've seen that a lot here of late where the futures have been down a little bit in the morning and then the market comes right back, goes to a new high. So this current uptrend isn't over until we start to print some daily lows, lower than the prior daily lows. We have to start seeing a series of lower highs and lower lows. That's how you end an uptrend. And right now we haven't seen that. So, take it for what it is. Let's talk a little bit about the market action from yesterday on Tuesday. Saw the Dow Jones Industrial Average gain 254 points, S&P 500 up 50, the NASDAQ up 270, mid caps up 17, small caps up 6.5. So everything up. Everything looking pretty good, moving back through key moving averages. We're above the 20, we're above the 50. We haven't gotten the golden cross yet where the 20 comes up above the 50. That would be, another tactical step in the right direction. Also, we haven't, since breaking back up above the 20-day, we have not come back down yet for a test. That's going to be interesting. When the selling kicks in, is it just a little bit of selling back to the 20-day and then we bounce and go to new highs? If so, that's a much more bullish technical sign than the alternative where we just go right back down below the moving averages. That would be not a great sign. It would really start to maybe lend more of an argument to the fact that maybe we go a little bit lower, maybe one more time. So watch that rising 20-day EMA on any weakness. I actually get a lot more information from the market on weakness than I do on strength for the most part. So I'm going to be looking to see how the market reacts when we move lower. Do we bounce off of key areas? What type of leadership do we get if we do bounce? Does money rotate right back into those aggressive areas that we've been seeing, with strength over the last week or so? Or do we get a really weak bounce with weak leadership? Those things are going to be important as we move forward. And I'll talk about some of that a little bit later today as well. From a sector perspective, strength continues to be in the aggressive areas, which is good, right? Discretionary, communication services, financials, technology. These four areas are leading this bounce to the upside. That's good. Beats the alternative, but I wouldn't exactly say we're out of the woods. Anytime the market goes up, generally you're going to get leadership from those, those more aggressive areas. What I'd really like to see is leadership from these areas when the market goes and sets a new low. That would make me much more excited about a potential bottom forming. And it doesn't mean that's how it's going to form. I'm just saying that would be a signal that would really, if you look back to the 2009 low, a lot of that money rotated to aggressive stocks, even though we went and set that March 2009 low, which went below, I think it was the November 2008 low. We went down, set new lows, but a lot of our ratios, our sustainability ratios, it actually moved in the other direction. So instead of confirming the move to the downside, it was actually predicting a move to the upside with prices moving down. That would be awesome. I don't know that we'll get that, but if we do move lower one more time, it would be great if some of the aggressive areas held up on a relative basis and didn't go to new lows. So seeing these groups bounce on this move up is good, but holding key relative support levels on another move lower in the indices would be better. So something to think about. Energy, the main laggard, that was down about 0.75%, but you can see the other four groups I pointed out here all up from about 1.5 to 2.5%. So really good day again yesterday. We continue to print those higher highs, higher lows. We were down at one point, came back in the market. So right now we're showing that resilience and keeping that short-term uptrend in play. And that's simply what I'm watching right now, waiting to see if that uptrend remains in play or if we do get a reversal. 10-year Treasury yield, not really any, well, actually there's one economic report out later this morning. New home sales will be out later this morning. And the expectation there is 810,000 units. January, by comparison, was 801,000 units. So we're looking for a slight pickup in February, but interest rates really been snuffing out the home builders of late as rates continue to rise. It just makes it more expensive to purchase and own a home. And so that definitely will have an impact. And if the Fed is correct, and they do raise rates many times going down the next year or so, I would expect that's going to take a toll on home builders, continue to take a toll. All right, but right now, 10-year Treasury yield clearly in this uptrend. I mean, look at all these hollow candles. That to me is just telling you that's a lot of distribution taking place in Treasuries, because when yields are going up, it means the prices, Treasury bond prices, are going down. Always a 100% inverse relationship there. So if the yields are going up, prices are going down. It means folks are selling bonds. And a lot of times you sell bonds when you think when the economy is gaining strength. I don't think that's what's going on here. I think what's going on here right now is we're seeing a lot of selling because the Fed is talking really tough about inflation. And if you're fearful of inflation, then you're going to sell bonds because you expect much higher returns from bonds. You're not going to accept a 2% 10-year treasury yield if inflation is going to continue to roar at 6-7% or higher. All you're doing is losing money. So that doesn't make a whole lot of sense. I mean, you still keep your principal, but your principal is literally being eaten away by the inflation. So anyway, that's normally what would happen is you'd see interest rates going up. The reason I think it's going up now because of inflation as opposed to prior advances is because look at the financials relative to the S&P 500. Financials are going down over the last month. Normally, higher interest rates are great for financials. And you can see when we bottomed here and started moving up, nice rally. We come back down, and then we had this huge rally and just a little bit, just a tepid move to the upside in the relative strength of financials. So this is telling me the market's a little bit more nervous right now about inflation. You wouldn't see it, if you're looking at the stock market the last week or so, but please remember, we talked about this a ton last week. There was financial incentive for the market to move up last week, a lot of financial incentive in the term or in the way of just, tons of in the money put premium. So a lot of that put premium that market makers would have had to pay out completely disintegrated with that move to the upside. So they had to pay out a little bit more in terms of calls as prices were going up, but they got rid of a ton of net in the money put premium. So the amount of money that was on the table and the amount of money that market makers legally stole from a lot of retail traders was in the billions. We're talking billions of dollars last week. So if I sound a little skeptical about this rally, that's the main reason, is that we've seen this all before. We know what happens option expiration week. If you're a member of Earnings Beats and you've been a member for a while, we've been through many of these periods where all of a sudden things just change on a dime. Why? Well, a lot of money at stake. That's number one. Now that we're beyond option expiration week, you got to be a little careful, be on guard. If you're long and you're riding this move to the upside, that's awesome. Congratulations, but just be ready. If another shoe drops, I would make sure I take my profits on the long side. All right. So anyway, the 10-year treasury yield continues to move higher. It's up a little bit today, another basis point or so. And we'll see what happens, throughout the day today. All right. S&P 500, going to go through a few charts on the S&P very quickly. So on the daily chart, this is that action I'm talking about. 1, 2, 3, 4, 5, 6 straight days, higher highs, higher lows. An uptrend will not end until that changes. As long as we keep putting in higher highs and higher lows, the uptrend cannot end. It can only end when you start to reverse. So as long as this stays in play and you're on the long side, stick with it. I have no problems. I think 4,600 could come into play here on the S&P 500. I think if we move through 4,600, that would be, I think, a much more definitive signal that the bottom is in. Because at that point, you have this lower low, lower high, lower low, and then this lower high is not the top of the trend anymore. You're breaking back through that double top. That would be, to me, a sign that a reversal is, which we've been seeing, is confirmed. So if you're really bearish the market, I mean, like significantly bearish the market, you don't want to see the S&P closing above 4,600. I think that would be a very, obviously any head fakes are always possible, but that would be a more definitive sign to me that the bottom is in and that we might go sideways, we might consolidate, but I'd be very surprised at that point to see another low. So right now I'm sitting there maybe on the fence. Maybe I'm 55-45 thinking we go lower, maybe 60-40, thinking we still have one more leg to go. That would change on this move through 4,600. I would probably turn more 75-25 that the bottom is in. So this is the daily chart. How about the hourly chart? Well, right now you got to be careful because we do have higher prices on the S&P and a lower hourly PPO. So we have a negative divergence now that has formed on the S&P 500 from an hourly perspective. So that would tell me maybe we go back down to the 50 period moving average. And that would be what, 43.57 right now. 43.57. If we go back to that daily chart, look at the 20-day EMA at 43.62. So if the negative divergence plays out on the hourly chart and takes us down to that 50 period or 50-hour moving average, it also would be taking us down to about the 20-day EMA on the daily chart. And that's where a major test would come in on the daily chart. So from where we are right now, I could see 140, 150 points off of the S&P 500. Just a normal pullback. So if we start to break below and we set a new daily low from the prior day, that would probably be my short-term target. And then we'll see whether or not we hold. If we don't hold, that's going to really start to open things up to the downside. I think we'd see the volatility index begin to pick up and a little bit more fear creeping back into the market. So a few things to look for there. Now, here's a 15-minute chart that goes 10 days. And you can see after going down or sideways down, we hit that low back on March 14th, 15th, something like that. It was the Monday. Well, it was last Monday. So I guess it was a week and 2 days ago. That was the low we hit down at 41.65 or whatever it was. Since then, this is that pattern, higher highs, higher lows every day. Here we were down much of the day, but we never went down below the prior day's low and then rallied right back up. So you can see we're in a consistent, steady uptrend. Hourly charts suggest that maybe we're running out of momentum to the upside. We do see futures down a little bit today, but we've seen that before. Do we go back and take out yesterday's lows? That's the question. And that's the thing I'll be watching, not just today, but, you know, in future days. All right. Moving on, I wanted to go through a few industry groups. You know, we've seen a lot of the growth areas moving higher here just over this last week or so. So I thought it'd be good to take an, you know, have an update on some of the key industry groups that normally lead a secular bull market. And let's see what they're up to. First one, software. Well, I mean, it's been rallying nicely. It's getting back up above that 50-day moving average. First time it's seen a close over the 50 days since December 27th. Well, maybe 2 days ago. I can't tell if we actually closed above the 50. It was pretty close. But outside of that, it's the first close above the 50-day moving average on software since December 27th. Well, that was the breakout there. Well, yeah, because that was the only close above the 50. So December 27th, it's almost 3 months later. So this is definitely a group that could help turn things around. And we did get through the 50 now. Having said that, Adobe Systems reported earnings last night. And while I believe they beat on their bottom line, they did offer some cautious guidance going forward. The stock last time I looked was down more than 3%. But Adobe has not been one of the leaders. And I'll show you that chart later. But it has not been one of the leaders. So I don't know whether or not, you know, the overall software group necessarily is going to respond negatively to that. One thing very interesting about this group, though, is it's gone lower, significantly lower. We're down, even after this rally, we're still down more than 1,000 points from the high back in November. But what's really interesting here, the AD line is at an all-time high, or at least 52-week high. I'm pretty sure it's an all-time high. So what that tells me is some of these big volume days, I mean, look at this huge hollow candle. So yes, we were going down, 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 but when we get the big volume, you got plenty of buyers there driving prices up. And so it's all of these hollow candles on heavy volume that's driving this AD line to the upside. So I believe software stocks remain under accumulation, even though they're down 1,000 points from where they were back in November. To me, this is really bullish for the long term. Now, does that mean that software can't go back down again? I wouldn't say that. I mean, you know, we did go down quite a bit. 6,300 to 4,600 is a lot. And there's some people out there saying, yeah, but the S&P 500 hasn't gone down 20%. So it's not a bear market. Tell that to anybody holding software. I mean, we're talking about what, 27% from this point to this point. Hard to argue that you're not in a bear market when one of your leaders of the secular bull market's down 27% in 4 months. And it's not the only group. Here's your semiconductors. Semiconductors, all these tops up here on 97.50. We got down to 72.50. It's 2,500 points. It's over 25%. Semiconductors were down. So if you want to argue over the S&P 500 not being down 20% as your reasoning for the fact that we're not in a bear market, I mean, go ahead. But as far as I'm concerned, this has been a cyclical bear market, and I'm not sure it's over yet. But semiconductors back above the 50-day moving average. We had not seen a close there above the 50 since all the way back to the beginning of the year. So things are improving, but we're rebounding. That's, normally you're going to see things improve when you rebound, just by the nature of technical price action. When prices move up, a lot of indicators move up. Look at the PPO. PPO is back to the center line. Are we out of the woods? No. I mean, we could move above the center line and then roll right back over. Again, are we trending to the upside on the daily chart? The first test of the 20-day moving average is going to be our clue. Do we bounce off of that and set a new high? Do we go back down, hit it, and then move up above these recent highs? If we can do that, then it's starting to paint more of a bullish picture, shorter term. Long term, like I said, long term, I'm still very bullish. I have never wavered. No one has heard me say anything bearish about the long term. I haven't written about it. I haven't talked about it. I believe we're going higher. I think a year from now, all of this is going to be in our rear view mirror. I just, even if rates are going higher, interest rates are going higher. Do you know that interest rates, I think, were raised 13 times from 2004 to 2006, and the S&P 500 went up during that period? Higher interest rates by themselves don't mean that you're going to end a rally, a secular bull market rally. Interest rates are still near historic lows. And if they get raised 9 times, like the Fed says, guess what? They're still going to be much closer to historic lows than they are anywhere near problematic interest rates. And when I say problematic, I'm talking at least 5%. At that point, you start having other things that you can put your money into. Instead of, parking your money in the stock market, you could, CDs start to become a little bit more attractive. Treasury bonds become more attractive. There are alternatives to investing in the stock market. When you got rates down this low, the stock market's the best place to turn. So anytime the market gets beaten up, money rotates back in. We're seeing that in the last week. Again, the question is the bottom in? I don't know. That's a tougher question to answer. Back at the beginning of the year, I pointed out on the S&P 500, I thought minimum downside would be 4,300. And I thought maximum downside could be as much as 3,500 to 3,800, somewhere in that range. We got down to 4,100 and change. I mean, we went below the 4,300. We're in that range where we could bottom. So for me, it's just whether or not we have one more move to the downside. And there's still a lot of things to be fearful about. There's still a lot of uncertainty over inflation, how many rate hikes we're going to get. And probably the biggest one yet that a few people are starting to talk about is a recession. I think we're going to have one. Is that built in, or is that going to be one more excuse for the market to go down one more time? Don't know. We're going to find out. Anyway, semiconductors, definitely have strengthened. Here was your breakdown, 87.50. We had a reaction high up probably 86.50. We got to get back through that. So there's still more upside potential, but this is a group, if the market turns down, that's very aggressive and could go down right with it. Autos breaking back out. Tesla's had a huge run here over the last 5 or 6 days. Still one of my favorite stocks in the market. But it's not out of the woods. It definitely looks better technically. But again, what happens when we go back and hit that 20-day? Do we bounce? Internet has been probably one of the bigger problem children for the stock market. We have bounced. That's good. Unlike the others, the AD line is not broken out. It remains way below where it was back in November. It hasn't gotten through the 50-day, so you can see on a relative basis, not doing quite as well as some of these other areas I'm pointing out. But it is now above the 20. Does it hold the 20 on a pullback? We'll see. All right, ratio, growth versus value. Now, this is where you've got to kind of, again, keep things in perspective. Yes, the growth stocks have had a huge run for the past 6 trading days. Look at where we were back at the beginning of December and where we got to and where we are now. Are we out of the woods? I wouldn't necessarily say we're out of the woods looking at this chart and some of the other sustainability ratios. I mean, we could look at the XLY, XLP, and I'll look at some of these again in a little bit more detail later today. But this looks better. We've gotten through the 50. We've gotten through the 20. We're trying to get through this reaction high. Notice lower low, lower high, lower low, lower high, lower low. Not quite getting through that high. So are we going to break down here? Do we continue this move to the upside? If we do, that's a really strong positive for the market. So watch what happens in consumer stocks. You know, if we're going to have a recession, consumer, you know, the consumer spending part of our GDP is what's going to be impacted the most. So consumer stocks and how one area, discretionary, performs versus the other area, staples, is really an important component because it tells us whether or not the market favors the higher growth and the more aggressive discretionary area or the more defensive and more earnings predictable staples area. So right now, you know, over the last couple of weeks, not just the last week, this was options expiration week, but even the week before that, we saw money rotating into discretionary stocks. So this has been going on for a couple of weeks now. Do we make this breakout? That would be another positive, something to watch. All right, earnings spotlight. Talked about Adobe. Here's the Adobe chart. The stock, let me go on my other account here. I'll give you the updated price here in pre-market. It's down 5% now. It's down $24 to $442. So it's back down here. It's below its 20-day moving average. Is that an opportunity? Do we rally back off of this move back down below the 20? Can we hold the 20? That'll be one thing to watch on Adobe today. The thing I don't like about Adobe is when you look at it on a relative basis to software, you might look at the chart and say, well, it's bouncing, so it's fine. Well, it's not even really bouncing any more than just the software group itself. I mean, this is still really flat, and it's close to a 52-week low, the relative strength. So if you do believe in software, I would say that there are a lot of other better software stocks to be looking at than Adobe. And because the stock has been downtrending, you know, my belief is we should not have been expecting much in the way of their earnings report. And they issued cautious guidance, and hence the stock's down 5%. So you do want to pay attention to relative strength, especially if you like holding stocks into earnings. I would be very careful holding stocks into earnings that are showing terrible relative strength. Even if you get a bounce with earnings, a lot of times it's a fake to the upside. There's a reason why Wall Street, many times, there's a reason why Wall Street is not favoring a stock among its peers. All right. Let's see another stock that we can talk about here. Well, Tencent reported, and that is TCEHY. Tencent is down 6.64%, or it was. Let me see what the latest there is. Yeah, down almost 7%, down to 47.15. So here it had been selling off, got a little bit of a rally here before earnings, and now if we lose $47 on a closing basis, and like I said, we're at about 47.15, we could go all the way back, fill this gap back down near 40. So 10 cent, not looking particularly sharp there to me. GIS, General Mills, reported. So this is a consumer staple name. They beat 84 cents versus 77 cents. And they are up about 3.3%. They're up to 64.75 right now. So just above the 20. So this is a question of whether or not we can stay above the 20 with the, and see if we can continue this move to the upside. That will be very telling in the near term. And then Jinko Solar in the renewable energy space had a big beat. And the stock right now is down almost 5%, back to 51.45. It is still above the 20-day. And when you look at it, it's still very volatile, as you can see, but for the most part, trending up versus renewable energy. And renewable energy is trying to strengthen here a little bit the last month or so. Relative strength starting to pick up. So Jinko needs to hold the 20. If it does, maybe we see a rally off of this gap down. All right, the three you must see, and then we're going to wrap up. It's 9:30. Let's do first CrowdStrike, CRWD. I like the recent break, getting back up above the 210 area, 212, 215 even. Got up to almost 220. Actually, I think intraday, yeah, 219.75. But do we hold it? When we pull back, do we hold the rising 20-day? I like what I'm seeing here on CrowdStrike. Would I chase it? No, not knowing what I know about the market, I'd be a little nervous. But again, on the pullback, the 20-day, if you wanted to take a shot, that would be the place to do it. If it doesn't hold, you just simply exit. I would not, well, I mean, I like the company longer term. So this is one that I think if you held a while, probably would be okay with, but that's up to each individual. That's not really my style. I don't just buy and hold, especially if things start to break down. I tend to protect my capital and get out. But this is a type of stock that I would expect to do well in a secular bull market if I'm right about that as we go forward. Next, AYX. This is a software company that's starting to show some strength. It had been going down. It's been going down for a long time. It really didn't participate in a lot of the move in software last couple of years probably. But it's starting to show some nice strength, good volume trends. And look at the AD line moving now to about 11-month high. So it looks like there's a lot of accumulation taking place. It is down a little bit today at the open, but any kind of a pullback to this area of the breakout down around 63, 64, I think would be very interesting on AYX. And then lastly, another stock that's changing its look on the chart is Sunoco Products. And here you can see this is a company that had been downtrending for many, many months. Looked like it was breaking that downtrend right in here. Volume was picking up. The 20s above the 50 were holding it. And then we had gapped up yesterday, gaining, I don't know how much ground that was, about $3.50, something like that. And now today looking to potentially add to that. Right now it's down, what, 3/5, 0.6 of 1%. But anything back down into this gap support area, probably 60. I don't know if we go back down below 60. That was yesterday's low. And then the buyers came right back in on some pretty good volume. So maybe 60. And if you wanted a second entry, maybe 58, 58.25, something like that. But this one looks like it's changed character on its chart from downtrend now back to uptrend. So I'd be looking at this as a possible entry on any weakness. All right, that's about what I have for today. Let's take a quick look at the market. See, yeah, we got the NASDAQ down 128, Dow down 199. On a relative basis, NASDAQ getting hit a little harder. Now, during Max Payne week, we saw NASDAQ stocks, many of them heavily traded in options, of course, do really well. So on a relative basis, the NASDAQ's been doing well. But I keep watching that 10-year Treasury yield rising and wondering at some point if the NASDAQ maybe has just kind of run its course, especially on a relative basis. Maybe that's starting now, maybe not. Like I said, we have seen the market down in the morning and then come roaring back. Very possible again today. I am a little nervous about the 60-minute negative divergence on the S&P 500. I think that could be a signal that maybe this thing's run its course. And we might need to go back to that 20-day test to see what this rally is really made of. And that is where I think we're going to find out. Not just going back there, but then everything else in the market. How does it trade? Are we seeing money rotate strongly again away from, the NASDAQ stocks on that potential pullback? Those are some of the things to watch for. We're going to talk about this and a lot more tonight at 4:30. So if you can make it, it's a free event. Go over to Earnings Beats. Make sure you go over to Earnings Beats. And right here, all you have to do is scroll down and subscribe. Name and email address is all it takes. No credit card, to our Earnings Beats Digest newsletter. That's the group that we will be reaching out to later today and giving room instructions to. And it's, again, completely free. So love to have you. Check it out and get the latest on what the market's going to look like. And we might have a reversal today. And if we do, we'll have plenty to talk about later today. Anyhow, everybody have a great day. I'll be back tomorrow over at Stock Charts TV. So at 9 o'clock tomorrow, you can listen to my latest recorded version of Trading Places Live. That'll start 9 a.m. Eastern. Just go to Stock Charts TV at 9 a.m. and click on it and check it out. Everybody have a great day. Hopefully see you later this afternoon. Take care. Happy trading.